We have Parker, excuse me. Rachel is a partner at PwC in their financial services practice and is the advisory market leader of PwC's Missouri market. Okay. And from tick size and decimalization to the really nitty gritty liquidity measures, we are moving to a big picture here. And Rachel is going to release PwC's Capital Markets 2020 report and give us a sense of what's to come for the capital markets in the next decade. Thank you, Rachel.
Thank you, Professor Agarwal. And to elaborate just a little bit on my background, as she mentioned, I am in PwC's advisory practice. I actually run the group that caters to the financial market utilities, the clearinghouses and exchanges. So in that capacity, the market structure is relevant. From a personal background perspective, I was an econometrician when I first came out, and that actually has carried forward through my career to a level of fascination with market structures and market quality. So for that, I'm very grateful to be speaking today. And specific to the clearinghouse and exchange space, cut my teeth in some of the May You Live in Interesting Times period of 2008, helping launch credit default swap clearinghouses both in the US and Europe. So kind of in the heyday of chaos, was actively involved in the clearinghouse and exchange market. So that kind of brings my interest in one of the reasons I run that practice for PwC. So the paper we're releasing today, or announcing the release of, I'll call today the teaser, maybe the ad for it. It'll be finalized this fall and be out shortly, is PwC's Capital Markets 2020 perspective. So what we do as a firm is we investigate and kind of invest in understanding what's happening at the biggest macroeconomic level. So as Professor Agarwal mentioned, from sub-penny execution, I'm going to take us to the other end of the spectrum, to the macroeconomic trends, or you hear us call them the mega trends, that really shape the market. So that starts from the mega trends themselves. PwC identifies 7 mega trends. Those are evidenced by facts along the lines of, if you look at the population of China has 21% of the people on the planet. China only has 6% of the fresh water on the planet. We'll take kind of big information like that, distill it down to some of the capital markets, financial services views, and then to capital markets. Things like, another one of the data points from the megatrends discussion is really 90% of the data that exists today in the world was created in the last 2 years, right? How does that change how the capital markets serve their clients, the information they have, the transparency, the market quality discussions that this conference is addressing at its core level? Then you take it down to the actual practitioners, the participants in the capital markets themselves, and you can look at the firms, and I do have to refer to my notes for some of the more specific details. If you look at the firms, the financial institutions will need to increase their previously announced expense reductions by an additional $30 billion to achieve an industry-wide return on tangible equity of 15%, right? That's on top of the $50 billion of announced cuts they've put in. So what's today's return on tangible equity? About 8.8, right? So to get back to just 15%, which they have experienced in the past, that's an additional $30 billion in expense cuts. So macroeconomic, population in China, down to financial services industry and how they interact, looking at some of the data trends, and then down to the firms themselves and their very fundamental economics. That's really what the Cap Markets 2020 paper looks at. So I'll give you a quick rundown of the 7 mega trends. I won't spend the entire time on them. They are kind of fun. You can go to PwC's website for the full detail. They look at that level of, apologies, I'm timing myself, and of all times, my whole phone goes off while I'm on the podium. Global instability. This is kind of like, for the record, this is kind of like trying to name the 7 dwarfs for Snow White. See if I can get all 7 right. Global instability, the big blanket megatrend under which the 6 underliers lie. The rise in interconnectivity of emerging markets, the relationship between G7 GDP and the emerging 7 GDP. Emerging 7 GDP will be 3 times the G7 GDP within the next 10 to 20 years. Okay? Demographic changes, including urbanization and some of those trends. Social and behavioral change, and I mention that specifically because Terry Duffy, when he was speaking today, was talking about that tone at the top, the culture, the need to have trust in your relationship with your financial markets institutions. That's a key component of that megatrend's implications for the financial services market, specifically capital markets. The last three I'll actually hit on in more details as we run through: technological change, the war for natural resources, and the rise of state-directed capitalism. All of these things, in fact, all seven affect. Today I'll talk about the last three: technological change, the war for natural resources, and the rise of state-directed capitalism. So the landscape that we started with from a perspective of today looks at the loss of high-margin product revenues for the capital markets providers. Costs are hard to contain. The return on equities are below the cost of capital today, right? So these firms have tremendous kind of cost basis that they can't support. You look at the fact that most of these firms are working harder just to stay in place. They'll call it scalability, but it's the cost to just stay in place when in fact they're moving faster and faster just to stay on par with each other. You look at the role of regulation, it's changed the economics of the business fundamentally, whether you talk about the intervention of the Fed and the construct of the interest rate, or Title VII and Volcker, which haven't even fully played out. We'll do so over the next 5 years. You look at the new entrants are actually becoming critical sources of capital: private equity firms, hedge funds, and asset managers. And what's interesting is they're disintermediating the traditional financial capital markets players. They're going directly to the sources of capital themselves. So they're kind of playing an interesting role disintermediating some of the capital markets providers. We've started to look at some of that. You get to technology, and it has its traditional role as a facilitator of a lower cost structure. We'll talk about that, but more specifically the role of data. And it's something I think almost every panel and speaker has talked about, whether in the role of transparency or availability of data or use of data. Then you get into, from the client side, the expectations of the client, and the financial institutions are demanding higher levels of service and value. And fundamentally, what's at the heart of that, from our perspective, is really that the information asymmetry that existed between financial firms and the clients has faded and will continue to fade in the coming years. So let's look at 2020. Okay, PwC's take on 2020, I will grant you that. What does 2020 look like given that landscape and those 7 megatrends? So if I look at the capital markets, we actually fundamentally believe they will continue to be a critical source of efficient allocation of capital. Okay, so the capital markets will become more important. We believe New York and London will still continue to be the centers of capital markets and capital allocation, while there is kind of curiosity and growing sophistication in Asia. In the next 5 years, we don't see that actually maturing into a competitor on par with New York and London. We'll look at the markets themselves. They'll be called upon to fund the infrastructure and the innovation associated with the demographic changes, the urbanization. So everything from the large project finance that was fashionable a while ago to the small, I'll call them the little icons that show up on your phone for Uber and for Whisk and for the services that actually solve a problem of urbanization. So not every person who lives in New York has or wants to have a car, right? These are capital markets opportunities to serve a growing need that comes out of an urbanization trend. So we see the capital markets being the source of that, the funding for that. Without a doubt, risk will continue to consolidate in capital markets, and market quality will become increasingly important. And this is something we actually spend a fair bit of time on. It's not just the transparency of pricing and execution, though with consolidated audit trail and the increased transparency on order flow, that's important, but it's also going to be a market quality that's the robustness of risk management, the quality around that, the allocation and support of capital for some of this, the ability to serve liquidity needs. And where appropriate, have capital buffers. And I say where appropriate because we were just hosting an event in Hong Kong where it's clear the regulator wants to try and apply a capital requirement to an exchange environment, which doesn't really make sense. So there's an element of the appropriate application of capital and an element of an inefficient use of capital. So, but we actually think the transparency around those risk measures will become increasingly important. From a technology perspective, as I mentioned, it kind of has that efficiency opportunity and continues to always have one, and it has a disruptor. So from an efficiency, what we actually see is the firms going through, and this would be more the broker-dealer firms, going through that next round of the word we use, and it is a made-up word. My grandmother, an English teacher, would be horrified. The utilitization of additional functionality. And by that I mean, if you look at some of the emerging trends today, there are certain activities within the cap markets firm that used to be a source of competitive advantage that basically are table stakes and everybody repeats the cost. The easiest example of this, and there is some emerging opportunity there, is around some of the anti-money laundering and KYC surveillance. If the industry created a utility that did that and served the industry's need, each firm wouldn't have to replicate the cost of some of that very expensive, data-intense, and arduous processes. So the concept, once again, of firms looking at their internal front-to-back office and figure out what really makes them differentiate their service to their clients and their fundamental competitive advantage. Outsource some of the rest of it. We're referring to that as the utilitization. You tell I really like that word. The utilitization of some of their back office. So, and you'll also see the firms dealing with, in the short term of that next 5-year span, the consequences of the proliferation of technology they already have and the complexity of their internal environments. There's a big body of work for the industry to get a little smarter about how they operate from a technology perspective. So those are the traditional roles of technology as the opportunity to create efficiencies. From a disruptor perspective, you start to look at the whole concept of better client experiences. You have the concept of multi-asset class platforms. The single dealer asset class model, we think, will die a slow, kind of suffocating death, and it'll be kind of the multi-asset class models that will in fact emerge as more successful in the next 5 years. You get that concept of a new platform with buy-side and institutional clients with a single source for many of the trading and risk management needs, right? A more sophisticated, user-friendly experience where you don't have to kind of go through different silos to execute what you want to execute. You'll also see that concept of data scientists moving into the front office. From our perspective, a lot of the data analysis is an offshoot of the IT department somewhere in the back, and you pick up the phone and call them. Occasionally, you'll have some sophisticated reports that you can play with, but the concept of the data scientist will move into the front office. We'll support a sales team that is directly customer interfacing, has a much more information-rich tool set at their fingertips to serve the cap markets clients. So that whole concept of a data scientist front office is a fairly new operating model for the industry. And then from a data perspective, the innovation to disrupt traditional models. So we've talked about the kind of processing horsepower. This is really about how it actually gets to, from a market surveillance, from a data management and cybersecurity, the opportunity that all this rich data, again, 90% created in the last 2 years, offers the cap markets firm. And that allows them to get everything from correlation between business units and risk factors and get much more sophisticated around some of the uses and applications of that, which we've seen people toying with around the fringes, but haven't really seen a mature approach to these days. And back to that other point, I think the information disparity, we mentioned this earlier, will continue to diminish between market participants and the capital markets providers themselves, right? There's more of a conversation of people are looking at the same set of information and demanding a level of service commensurate with their transparency. I think that's part of the regulatory agenda and opening it up, and I think it's part of the firm's agenda in serving their clients. So the last 2 points, which I will hit from a trend perspective, is really around the rise of state-directed capitalism, regulation kind of reshaping, and I would say this whole concept is characterized by the quote which says, a global financial system is local in a crisis, right? So that whole concept of the nation states themselves are seeking to better control their financial systems, and particularly their domestic financial institutions. That's pretty hard in a global market because their concept of a domestic institution is almost passé at this point. They're so complex and interconnected. Stability is the paramount concern, and you're seeing central banks heavily involved in regulating markets. And again, a more domestic focus. So, and you'll get the consequence of that is increasingly regulation is prescriptive and is happening at a local level. So we talk about the whole kind of arbitrage opportunity between different regulatory regimes. We don't see that necessarily softening in the next 5 years, but I think there'll be greater transparency around it, and I think that will force potentially a lessening of some of the most severe domestic interpretations of some of the right meaning, but necessarily not well executed regulation that we've seen come out. And then the last point I wanted to raise from the megatrend sourcing is the war for natural resources. So if you look at the concept of global population growth, rapid urbanization, you're going to put a lot of pressure on the natural resources. As I talked about China, 21% of the world's population, only 6% of the fresh water. That's indicative of many trends that the natural resource shortage will afford. You can oil, you can pick your natural resource of choice. Water, I think, to me is one of the most easy to understand. The consequence of that is actually we see around market volatility, new regulation and protectionist behaviors around some of the natural resources that we think will play out over the next 5 years. And I think for the capital markets, the lens we put on that is really around the opportunity for the markets to allocate those resources or access to them or potentially transport. Terry was actually talking about a bushel of corn transported to China cost $5. A bushel of corn in China cost $10, right? That concept of food scarcity and things like that, I believe the war for natural resources will play out kind of in the capital markets very explicitly around water, food, things of that nature. So that's kind of an allusion to something Terry brought up. And then from the PwC paper, we gave you a little teaser of it here. There are kind of 6 recommendations. We are an advisory firm. We'd like to have some advice in the face of all these daunting trends in the next 5-10 years. So continue and, in fact, invest more as firms in managing regulation, risk, and capital. Not a shocking revelation there, but if you actually look at risk as the correlation between the asset classes and the business units, don't take it as a traditional management credit operational risk. Create the connectivity between your risk tolerance, the correlations you have in your business, the risk characteristics. Use the rich data available to you to really understand the risk of the companies and actually manage that as an agenda item. We would also say that a lot of the controls that firms use and analytical requirements could use some additional investing, will be the polite term for it. There's a level of transformation that hasn't caught up with, I'll call it the control environment, commensurate with the sophistication in some of the risk management protocols. From the second point, from a culture and context, I think Terry actually evidenced that beautifully. He said, the traders are perceived as outlaws, and the financial market itself is perceived as a toxic kind of, I think the jokes are worse than the lawyer jokes of 10 years ago, right? The banker jokes have now superseded the lawyer jokes. That whole attitude has to change from the tone at the top all the way down to the compensation models for the front line. That concept of the traders as outlaws for people who aren't advocating for trust in the markets and the ability to actually create the transparency, we believe needs to change as a firm. The business models themselves, on to the third point, the business models really need to get to simpler structures with fewer products. I mean, today's headline was, you looked at CalPERS, who's divesting their hedge fund, their $4 billion hedge fund investment. Not a huge dollar amount for CalPERS, but their argument was it's just too complex. Right? Focus on what you're good at. Get simpler. Have a clean definition of your products, what you do, who you are. The last couple, strategically renew your operating model. Players have developed staggeringly complex operating models supported by staggeringly complex technology. It's time to actually take a look at that. And as much as it was refreshing to hear Commissioner Gallagher say holistic review of market structure, I think to a certain degree the capital markets providers themselves need to hold up a mirror and look at their own structures and figure out where they can simplify. From the last 2 points, enable client-focused innovation and obtain an information advantage. If you look at the capabilities out there to interact with clients, we believe that'll be the forefront of leading financial services firms' offerings, right? That ability to actually reach out, anticipate client needs, and figure out how to interact. Now, from the algorithmic trading and all of that, I can't tell you exactly how it's going to play out, but I think there's an opportunity there for banks to fundamentally change their relationships in that domain. And then the last point, the information advantage. I actually believe as much as out there is created in the last 2 years, is 90%, firms have yet to figure out how to harness it. I mean, I laugh. My grocery store has been keeping track of my purchases for years. What have they done with it, right? So what's the equivalent in the financial services market? They've been keeping track of it, but what have they really done with it, right? They've put it probably in a Blue Sheets report or some other report, but what have they actually done with it to understand their offerings, to understand their clients and the products? I think by 2020, they will have at least taken some substantive steps to address that. And then I believe the information asymmetry will end, particularly including the regulators, clients, and the market participants. I think there'll be a lot more out there whether it's the SIPS issues that have been dealt with that are, the latency is down. I think there'll just be a lot more out in the market that allows everyone, including the regulators, to have a more transparent view of the market. So in closing, I can't say that the specifics of the future are easy to predict, but they're not impossible to prepare for. And that's kind of the stance we've taken as a firm is you look at the evolution of natural resources, you look at all these things, it's obvious that there's shortage of certain things. How do we as a capital markets participants, whether it's regulators or providers or academics who study it, how can we actually help firms prepare for it and take some of the steps today? So that is the subject of the Cap Markets 2020 paper, which will be out shortly. Thank you guys very much for your time, and thank you, Professor Agarwal.